Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to another episode of the Finance Garage. As always, Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. Now today we're going to talk about our most recent budget that happened a couple of weeks ago. Now obviously the technicalities of it have already been talked to death on different podcasts and on news radio as well as on YouTube. Today, I want to hone into one simple area which I think the government has clearly got it wrong. And I think there are long-term impacts, especially for young people, which, according to the Labor government, was supposed to be addressed with this budget and the long-term plan of dealing with intergenerational inequality. And so today's topic is, are we punishing entrepreneurs? And the issue that we have is the way that the tax system, and especially targeting the changes to capital gains tax, will lead, in my opinion, to the death of risk-taking, both from investors as well as entrepreneurs themselves. Now, Australia is supposed to be the country where people are always given a go, right? We always say we want more innovation, more productivity, more businesses, more jobs. But the current tax policy direction may unintentionally discourage the very people that are willing to take the risk to actually create them. Now, some of you might be thinking, oh, Jonathan's a financial advisor, he's just defending rich people. No, it's got nothing to do with that. It is all about the incentive of taking risk to be an entrepreneur and having a payoff at the back end for all the sweat and tears. Because if we say that Australia wants innovation and productivity, but at the same time we increasingly seem to punish the people willing to take enormous risks to build businesses, then the latest federal budget and broader tax discussions increasingly focus on wealth redistribution and intergenerational wealth transfer. But the question nobody seems to ask is, what happens if there are fewer people that want to create the wealth in the first place? Which is where I think the government has undoubtedly end up hitting without even necessarily working out they are doing so. Because 90 to 95% of the employment in Australia is actually through small and medium enterprises. And to sort of kick things off, I think there is a public misunderstanding of what an entrepreneur is, right, from the layman on the street. Because most people only see successful entrepreneurs, right, in the same way that someone sees, oh, Elon Musk is really successful, or Jeff Bezos is very successful. Well, when they started from nothing, you had never heard of them before. Jack Ma with Alibaba, you never heard who Jack Ma is until he became successful. And so we only have this vision in our mind that a successful entrepreneur is the person that has the business sale, the nice house, and the wealth, right? The tangible things. What they don't see is they don't see the years of uncertainty, the low income, the reinvesting of profits, the stress, the personal guarantees you need to take out when you need to take out credit, and ultimately the risk of failure. Because I think there was a statistic, not necessarily an Australian specific one, but on globally, 90% of small business fail in the first 5 years. If we compare what an employee gets versus what an entrepreneur gets, from an employee's perspective, you have a predictable salary, you get annual leave and all the other leaves that are attached to it through our industrial relation laws. You have super, you simply take lower risk and you get paid every fortnight. But with an entrepreneur, at the end of the day, we have uncertain incomes. We're often underpaid for years. We carry all the capital risk because we need to fund the business ourselves off our own back, bootstrapped or otherwise, and we may end up having to sacrifice our lifestyle for over a decade. So If you compare it in a nutshell, employees trade time for income and entrepreneurs trade certainty for possibility. If we go back in time and consider the capital gains tax framework and why the discount existed, because it was introduced in 1999, it was to encourage long-term investment. It was there to reward risk-taking, the compensation for inflation itself, as well as, and ultimately, to today's point, encourage entrepreneurship. And I think there's an important distinction to make. Entrepreneurs usually don't actually become wealthy through salary. They build wealth through equity ownership, growing the actual business, and then one day finally selling it. And the exit event is often the reward for 10 years plus of sacrifice, delayed gratification, and enormous levels of uncertainty, which is what this new revamped, with inverted commas, capital gains tax creates more of. The capital gain at the end is the entrepreneur's deferred compensation for years of risk-taking.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Let me bring a nice simple example comparing the old system versus the new proposed system. And remember, at the end of the day, this has not passed both houses of Parliament. While the Labor Party does control the House of Representatives, they do not control the Senate, which means at the very least they will have to look at doing a deal with Greens or somebody else to potentially get it over the line. And depending on who you read and which bias, leaning you have in politics, you might be reading different articles as to which way this might swing. But using the proposed CGT go forward rules, let's make a simple example using a $10 million startup. And this effectively compares the current 50% CGT discount model versus the go forward from 1st of July 2027, the pure inflation indexation model. Now, we're also assuming that these laws started happening in 2015 just to create a base, because we need to sort of assume the inflation rate over a certain period of time. So we're going to use that inflation level from 2015 till now. And so let's say you started a tech startup in 2015 and the initial cost base or the capital that you raised was $100,000. You, the founder, spends 10 years building the business and then you finally sold it 10 years later in 2025 for $10 million. If we use the current system where it applies the 50% CGT discount, you sold the business for $10 million, your original cost base was $100,000, and therefore, one minus the other, your capital gain is $9,900,000. Because of the CGT discount, you cut that in half, so your taxable gain is half of $9,900,000, which is $4,950,000. And let's assume you're on the highest marginal tax rate at 47%, which you undoubtedly will be, given the fact of the amount of gain, then your approximate tax will be $2,333,000. That means after tax, you will pocket $7,670,000. So keep that in mind. After tax, using today's system, sell your business for 10 million, you will keep 7.67 million. If we use the indexation method, if you take around 3% inflation rate from 2015 till today, then your $100,000 is about $133,000. So that is your new cost base. So $10 million minus your cost base of $133,000 means that your capital gain is $9,867,000. And without the 50% discount, the entire gain is taxable. So instead of paying 2,333,000, you're looking at a tax bill of 4,640,000, which is effectively double. So your after-tax proceeds under the new system will be $5,360,000. Pretty much you're splitting half of the proceeds to government. Under the old system, you are splitting about a quarter. That is a huge difference. Old system, founder keeps 7.67 million. New system, founder keeps 5.36 million. The difference is 2.3 million. I think there's an important observation to make here, because over shorter periods like 10 years, the inflation indexation barely changes the cost base, right? So if you're in a super hyper growth startup and your time horizon for that business maybe, let's say 5 years, it's even worse. So while the government's pushing this theory that indexation sounds fair in theory, in practice for high growth businesses, it barely offsets the actual increase in tax. At the same time, and it's not something we're going to go into with much depth today, because there are some question marks over whether or not this part will pass, is this whole concept of the interaction between small business owners and entrepreneurs using trusts and bucket companies to effectively help minimize their tax or manage their tax liability. Because many small business owners actually do use discretionary trusts, family trusts, bucket companies, and it's not necessarily because they're rich, but because their business income actually in reality fluctuates over time and over years and months. Profits need to be reinvested, families work together, usually husband and wife, children as they grow older, and the business risk exists. So doctors, for example, there is liability, PI risks, and therefore you move liability to somebody else with a lower asset base. So the public debate that we're facing at the moment is that it is sort of hypothesized in the market that these structures are used as tax loopholes, but many are just small operators and migrant family businesses that are just finding a more effective way to manage their tax, right? And get a payoff at the back end as an entrepreneur. Because the bigger problem is that if the government of the day reduces capital gains tax concessions, they tighten trust taxation and reduce flexibility, then entrepreneurs actually could end up with a lot worse long-term outcome than salaried employees. And at the end of the day, if you, funnily enough, don't have a business, you don't have employees, right? So there's this sort of diametrically opposite problem we face today, whereby if this goes ahead and there's less entrepreneurs, that means there's less employment. If there's less employment, then what are young people going to do to help themselves get into their first home, let alone pay the ever-increasing rent today? So remember that the entrepreneur carries asymmetric risk, but increasingly receives less asymmetric reward upon sale or completion of the business, and that's fundamentally going to be the problem. And so if Australia constantly talks about declining productivity, which we've been in a declining productivity per capita situation for the last 2 to 3 years, we lack the innovation because we don't encourage it based on the taxation and corporate system. And we have weak business investment, which is then exacerbated by high levels of public sector spending, which we've seen since the current Labor government was employed. Then what incentives are we actually creating? I'm going to sort of say a little bit of hyperbole here, but why don't all of us just end up working for the government? If you compare Australia versus the US has a far more mature and very encouraging venture capital culture. It celebrates founders and it rewards equity upside. But Australia has become, unfortunately, increasingly reliant on property and banking and mining. And that's a whole different problem. If productive risk-taking becomes less attractive, the capital may shift towards passive investing, property speculation, and low-risk wealth preservation. And so, in conclusion, a healthy economy absolutely needs fairness, but fairness also requires opportunity. And entrepreneurs only exist when the reward justifies the risk. And if Australia keeps shrinking the reward for long-term risk-taking, eventually, well, who would have thought, fewer people will bother doing business at all. And with that, that's my thoughts for the month. Hope you enjoyed the episode. As always, if you have any feedback, hit me up on the socials and other topics you want to hear about in the future. Listen to the disclaimer at the end. And with that, I'll catch you in the next one. Bye.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.